What's going on, everybody? Have a special treat for you, especially if you like to save money. Who doesn't? Who likes to lower their taxes as well? So I've got here Mr. Clint Coons, who is one of the founding partners of Anderson Business Advisors. Clint, thanks for joining us.
Jeff, thanks for having me.
So you and I actually connected. Was it last month at a real estate meeting for dentists? And I went up to you and said, "Hey, I actually had your one of your partners, Toby Mathis, on here, and said, hey, would like for you to come on as well." And you kind of made a little comment and said, we'll make sure we get more views than him or something like that.
I said we're going to take it to the next level.
We'll take it to the next level now. There you go. So I'm really excited that you're here because I get people all the time that are asking me. I'm not an attorney, I'm not an accountant, but they're asking me questions for an accountant or for an attorney. So glad that you've joined us. So tell us a little bit about your background and how you help high income earners, and then we'll start diving into some specific topics.
Yeah, so my background, of course, as you stated, I'm an attorney, but I don't really hold myself out typically as an attorney. I typically, when somebody asks me in a casual conversation, what do you do? I tell them I'm a real estate investor because that is how I view myself. And that, I built a great firm with my partner, Toby Mathis. We started from humble beginnings of, 10 employees after we first got started. Now it's over 500 employees with offices in multiple states. But along the way, we realized the benefit of investing in real estate. I mean, I grew up in a real estate background. My parents were avid real estate investors. So I saw what passive income through real estate investing can do, not only to your lifestyle, but to your retirement, the things that you can do for your family and those that you care about. And so we realized, hey, we need to start investing. And my partner, Toby Mathis, and I started taking our profits and using strategies to borrow money from our companies and things like that to start growing our portfolio. And now it's over 300 properties, doors, probably close to 550, 600 doors in different asset classes. And that is the why, what drives me. It's something that I'm passing down to my children and explaining to them the benefits, and they're already started their own investing. And so here at Anderson, what we do is we take the legal and the tax side. So our firm has both CPAs and attorneys in amongst those 500 people, and we work with investors all over the country, and we utilize strategies that I think a lot of people just don't get, because if you're not an investor and you're a professional and you're trying to advise investors as to how they should structure themselves, you come at it from a very narrow perspective. And that if you're an attorney, you look at it strictly from liability, getting sued. If you're a CPA, you just look at it as reducing your taxes. And all of those, both of those are important. We do the same thing here at Anderson, but the one aspect in which we're different is that we want to know the why. Why are you investing? What are your expected outcomes, your goals from your investing? And you continue to grow your portfolio, the types of assets you're investing in. And then we put a plan together based upon that, because what I have found is there are certain structures and strategies you can use and really screw you when it comes to growing a portfolio. And you just don't know that at the time, because I made those mistakes myself.
Mhm.
Stuff I used to teach 18 years ago, I don't teach that anymore, because to real estate investors, it's not a path to success. So that's what we do at Anderson is we incorporate that whole process. So I call it a three-legged stool: asset protection, tax planning, and then the business planning side.
One of the things that attracted me to you and Toby when I was learning about the real estate was, man, y'all have just a ton of YouTube videos that are just, you break it down for a redneck like me in Louisiana that's not really smart, but you really dumb it down and you explain things real well. So I appreciate you doing that for people. And so one of the things that I wanted to ask about is, you kind of mentioned we don't really know what we're doing. A lot of times we make a lot of mistakes. So in your opinion, like new people, let's say I'm a dentist out there, I'm a doctor or whatever, and I want to start investing in real estate. Maybe I go buy a single family home, or maybe I go buy like a little fourplex or a mobile home park or something. Based on your experience, what are you seeing some of the common tax mistakes that like maybe new investors are making?
Well, the common mistake typically is that the way they're structuring their investment may not lead to the desired tax outcome that they're looking for. In that they don't understand that, if they go to their CPA and they say, hey, I'm going to buy this real estate investment and I'm going to cost seg the property, which means you're going to accelerate certain aspects of that investment from a depreciation standpoint so you can start obtaining tax deductions sooner rather than have them spread out over, say, 27 and a half years. You want to front load as many as you can to offset your income. And then you use the tax code with bonus depreciation so you can take it all in year one. And a lot of professionals hear about this. They hear about how their friend was able to write off $250,000 against his income this year. And they think, well, I'm going to do that. I'm just going to go buy a house. That's going to work for me. And then the CPA tells them, no, it's not going to work for you because you don't qualify as a real estate professional. Then you're like, well, how did my buddy over here, Fred, do it? And it comes down to understanding that there's a path there. You just have to outline out, when you're going into that investment, how you're going to get that benefit. And so the mistakes that people make is they don't think this through and they jump into the investment, they put a long-term tenant in there, and then all of a sudden now they realize, hey, this doesn't work for me anymore. I can't qualify as a real estate professional, so I don't get these tax benefits that I was counting on when I made the investment. And had we just changed how they were running that property, that is, make it a short-term rental and invest a little bit of time into running it, you can free up all these tax deductions. And I get it. If you don't like short-term rentals, you don't want to deal with tenants every 7 days. Neither do I. But let's just reap that benefit this year and then turn it into a long-term rental next year. So at least you get that big, huge tax break. And so it's things like that where they talk to professionals who do not understand the tax planning opportunities that real estate provide because they're not investors themselves and they just don't think the same way that savvy investors do when it comes to investing.
You mentioned you mentioned a lot of things, but for a new investor that's going, wait, depreciation, bonus depreciation, cost seg, that's like over my head. So can you break it down like in layman's terms, what exactly depreciation is and what it can do for you?
Yeah, so depreciation, essentially what it states is that an asset that you purchase, say a house, they allow you to write off. They say it's going to depreciate over time, meaning it's going to, think of it like an ice cube. It's going to dissolve over time. So you have 100% of that ice cube today. 15 years from now, there's only going to be about 47% of that ice cube left because it's melting. And so because that ice cube is melting, they say, well, you're losing value there. So you're now allowed to write off that melt. Every year, a certain portion of that ice cube melts away, so you have less value. So you get to take that as a tax deduction. So your house, your property that you bought, you're able to write off the loss in its value. And I know people say, well, the properties are going up. It is going up, but at the same time, you're losing value because things are wearing out in the house. And that's what the melt is with an ice cube. In your property, the roof is wearing out, the countertops, the landscaping is going to need to be replaced, the flooring, the HVAC systems, all of that is only going to be valuable for a certain period of time, and then it's going to die. So depreciation is designed to allow you to write off these things as their value diminishes with time. With cost segregation, what you're allowed to do is walk in and look at a piece of property and say, all right, well, the structure itself is supposedly going to last 27 and a half years. But there's certain components to that structure that there's no way they're going to last 27 and a half years, such as that shrub that's in my front yard. We're going to rip that out in 5 years. It's not going to last 27 and a half years. And so when you start breaking a property down, there are components to that property other than its shell of a structure that the IRS or the Internal Revenue Code recognizes have a shorter useful life. And so that's where the cost seg study comes in. When you buy a piece of property, like I bought a property last year, and after I put it into service and I started renting it out, the first thing I did is I performed a cost segregation study where somebody came in, a qualified expert. They said, all right, Clint, you spent $700,000 on this house. Now, the windows, the kitchen, the bathroom, the heat pump, the landscaping, the driveway, all these components that make up this property, they're not going to last 27 and a half years. They're going to be last 7 years, 15 years, 5 years. So they put all these numbers together. And they tell me when I'm going to have to replace them. Now, we know we're not going to probably have to replace them, but the Internal Revenue Codes, here's where it's your friend. They're telling you will have to replace it. So now once you've established that baseline and they tell you, all right, of this stuff that's not going to last 27 and a half years, the total value of that is approximately $97,000. Great. So now I have $97,000 in asset or a portion of my property that isn't going to make it to the end, the 27 and a half year mark. So ordinarily what you used to do is then just start depreciating it on an accelerated schedule, saying, all right, the stuff that's only going to last 5 years, I can write it off over 5 years rather than 27 and a half. So it creates greater deductions up front. But with the Tax and Jobs Cut Act that they passed back in 2018 allows you now to bonus depreciate, mean you can write off, well, this year it's 80% of that $97,000 in year one. So when we're thinking about property and cost segregation, this is the one thing that I tell people they should do. After they buy a property, the first thing you want to do after you put it in service, meaning you list it for rent, have a cost segregation study done on it. So you figure out how much you can write off in that first year. So I get $97,000 to write off in the first year versus if I did it the way that my old CPA might have told me to do it, they might say, hey, you get to write off $15,000 because we're going to just take the value divided by 27.5. That equals 15,000 bucks. So I get a greater upfront tax deduction by doing it this way. Now, when it comes down to writing these assets off, another mistake that investors will make is that oftentimes they buy a piece of property and they're going to rehab. All right. So they're going to go in, they're going to rip out the kitchen. Maybe the roof is bad because they got it at a discount. Right. So they know they have to do some rehab work. Well, a hidden strategy here is to put that property into service, which means you list it for rent. You perform a cost segregation study on it to figure out what that dilapidated roof is worth, how much life is left in it, your kitchen, and everything you want to replace. Let's say you get a number that's 45 grand. Then you take it off the market and you do your rehab work on the property. You rip out the roof, you rip out the kitchen, you rip out the landscaping, you rip out everything that you wanted to replace. Then you go in and replace it all. And after you do that, you list it for rent again, you get a tenant in there, then you run back and you do another cost seg on the property. Now, that strategy that I just relayed to you is something that so many investors miss out on. Because when you perform a cost seg before you rehab the property and the specialist determines the value of all those components you're taking out, you get to deduct those this year. Once you rip them out, you get a full deduction for their value. So on my example is 45K. I'd be able to write off the 45,000. Plus, after I put on all the new stuff, let's say I invest 90,000 into replacing everything. I come in, I do another cost seg, and they say, hey, everything you put in place, it's worth 90 grand. Great, I get to write that off. So combined, I'm able to write off $130,000 in year one. Where a lot of people who buy properties that they intend to rehab, they don't even think about doing that cost seg on the front end. And then they do it on the back end. And the only thing they're able to write off is the 90,000, all the new stuff. And they don't get any credit for everything they took off.
Do both of those need to be done, performed in the same year?
No, they don't have to be performed in the same year. Not at all.
Okay.
but you're giving up. If you're thinking about you're going to rehab a property and you're going to be investing a considerable amount in the rehab,
Mm-hmm.
you're best to do a cost seg on the front end, because I've talked to so many professionals who have, done this,
Mm-hmm.
and they've missed out on 40, 50, $70,000 in write-offs because they didn't do that cost seg before. They said, no one told me this. I thought I, would do it after everything's said and done. I said, yeah, I know that's the typical way of thinking, but there's really, the code allows you to deduct it on both sides. But if you miss this opportunity here, then your hands are tied. And so those are big numbers. If you had $70,000 and you're in a, say, 37% tax bracket, I mean, what's that, about $35,000? You just blew away because you didn't perform a study.
Yeah. Plus, you've got an asset now that's going to be giving you passive income. Again, it's just making that shift. So, speaking of that, I mean, you're an attorney. You had to go to college, and then you had to go extra training. I've gone to dental school, then a residency, so I've had extra training. So we go through all of this, and we're never taught. We're always taught we have to trade our time for money, right? And that's just how it is, because back, probably you're the same thing when we were growing up. Really, if you wanted to make, quote, good money, you had to go to school. You want to make really good money, you had to go to school a long time. But now that is, certainly not the case. And I'm teaching my two kids, they're teenagers now. So in our mind, our mindset was back then was, okay, we're going to get out, we're going to be 25, 30 years old, and we're going to work for 30 years, 35 years, and that's it. Everything is just on us, right? And that's our mindset. But when you start hearing all these other things that we can do, like buy a property and do the cost seg, or do this, do a syndication, and it's just like, man, it just starts to open up your mind. So in your opinion, how important is mindset when it comes to your work, to your money? And did you ever have something in your life when you were growing up where maybe you went from one type of mindset, maybe like a fix, to a growth? Or what are your thoughts about that?
My father, like I said, he's a real estate investor. And growing up, we used to, or he did this for a while, where he would find a house that's going to be torn down. We'd go to the seller or the owner of the property and tell him, hey, let's tell you what, I'll give you $1 for that house. And the seller would think, you're going to pay me for this? He goes, yeah, give you $1. I'm going to buy the house off of you. I'm going to come in, I'm going to jack it up off the foundation. I'm going to pick it up and I'm going to get rid of it for you. So you don't have to tear anything down. I am going to remove the entire property for you. And so he would buy homes for $1. And then what we would do is he would buy a lot. So he already bought these lots. We'd put a cinder block foundation on it, bring that property in, drop it right down on the cinder block foundation, hook up all the utilities, skirt it, do some rehab work on it, landscape it, turn it into a rental. Automatically you had, say $60,000, $80,000 in built-in equity from day one, because it didn't cost you anything other than $1 for this entire structure. Now, he was doing this, and it worked for a number of years, but then people started to get wise to, hey, this house, these houses, they're worth something. There's investors like my father, they'll pay me more than $1. And so his strategy, it just wasn't as profitable, the return. His ROI in doing it, as the seller started demanding more and the costs of moving went up. That just kind of petered out, but there was a window there. Now, my point in telling you this is that my father's mindset has always been a cost mindset. And that when we would drop this house on the foundation, the people who would spend the time working on that property, putting together, like I said, hooking up all the utilities and skirting it and decking it and doing all that, was myself, my brother, and my father. We'd go out there after school, on the weekends, doing that until that property was ready to be rented. Now, the reason why we did it ourselves is because he was saving money, right? He had why pay someone to do this? Because if I do it myself, I'm going to save $10,000. So it was that mindset of, hey, I get to save this. But rather than have the investment mindset, which is, I'm going to hire someone to do it for $10,000 because my time is more valuable finding 20 other properties at a buck a piece, negotiating that deal, getting the lots, dropping them on, and just rapidly build my portfolio. He didn't approach it that way because he saw this as, hey, it's going to cost me 10K to hire somebody, and I don't want to spend that $10,000. Well, great. You saved $10,000 there, but you lost $60,000 by not buying that other property over here. So at the end of the day, you're behind. You're not moving ahead as quickly as you could. And so that's always been an issue that I've seen with him. And we always talk about it. And I said the difference between myself and him when we're talking about my investing and how fast it's grown, as I said, Dad, when I see something, I don't look at, I look at the cost, of course, but I don't see it from your point of view. I look at, how do I get this deal done? What is it going to do for me rather than what it's going to do to me? And you're always focused on what it's going to do to you, as far as how much is it going to cost you, this, and this. And you're always putting that in. You have to do that. But at the end of the day, you need to look at it from the other side. What is it going to do for me? And then when that opportunity comes along, you need to be ready to take action. And a lot of people don't understand that. They don't put themselves in the position, such as if you have retirement funds, where are those money sitting in an IRA right now? Not in a traditional IRA, not in a self-directed IRA, because that's a source of funds you can use to pick up a deal. Do you have an entity set up? So if an opportunity comes along to close on a piece of property, you're going to close in your own name or are you going to close in an LLC? I would tell you should be ready to close in a limited liability company, but a lot of people aren't positioned that way. So that opportunity comes along, they put the offer in their own name, and so then they go on title and they want anonymity, but that ship already sailed because you didn't put the structures in place to begin with to lay the foundation. So when those opportunities are there, you can execute. Instead, you're always playing catch up. And the reason this comes back is to my father's mindset, which is, gosh, if I hire an attorney to set up a structure for me, that investment is going to be $5,000, and I don't even own a property yet, so that just doesn't make sense. I would never do that. I'd wait till I got the property. Well, if you're committed to doing this and you lay the foundation, when that property opportunity comes along, you're going to take title the right way, and it's never going to be in your name. Versus those that don't lay the proper foundation, they're going to be struggling trying to play catch up. And there can be a number of problems. Let's say you buy it, you close in your own name, and then a lawsuit hits you. Now you're being sued personally. I mean, you talked about this. Why do we buy? To create passive income, to understand you don't need to keep trading your time for money. But then if you haven't structured it the right way, one lawsuit wipes all of that out. All that effort, that work you put into it disappears because someone sues you. And then you're sitting around going, man, I have to go back to trading my time for money again. And that's harder to do it the second and third time. You don't want to be there. And I've talked to hundreds of people that have been wiped out because they had that cost mindset. They didn't make the proper investments to protect themselves, use the strategies that are beneficial to them from a tax side. And they wonder why their neighbor's doing it so much quicker than they are. Just because they're not there yet. They don't get that.
I have a neighbor, our old neighborhood, and he was an occupational therapist, and he was like, he would save up like maybe 3 or 4 years, and he would buy these $125,000, $150,000 houses. He'd pay for it in cash and move on to the next one. And I think when we had a conversation, he was at like maybe house 4 or 5. He's like, man, Jeff, if I could just get to 10 houses, I'd be set. And I was kind of doing the math in my head. I was like, thinking he was going to be about 70. It was going to take him using his method. So, he's saving up. And then by the time he's about 70, he would have, 10 houses. And that was his mindset. It was the cost. It was kind of like the fear of any type of good debt, because he was just like kind of had the Dave Ramsey mindset, which I did, growing up. That was all I had back then. It was like, all debt is bad. We're going to pay off. We're going to use the debt snowball and all that. And so I was thinking, well, now that I've been exposed to a different type of mindset, like you're talking about, he could have just saved up for maybe instead of buying two houses, saved up to 300 grand and put a down payment on all 10 houses right then you got all these tenants paying all the bills and you're getting the depreciation. He wasn't getting the cost seg. He wasn't doing any of that stuff. It was just like, man, here's the information, whatever. It was just totally just blocked it, and I think if you're just closed minded like that, it's really hard to grow.
Well, when I was in my early 30s, we used to vacation in Maui, Wailea, and we'd stay in a condo. And we went there probably 8 years in a row for 3 weeks. I'd work part time and then spend time with the family. And each year when we got there, I'd think, maybe I should buy a condo. And I would look at the price, be like, $700,000. What idiot would buy a condo for $700,000? That's just stupid. Next year I came back. That condo, 825,000, 900,000, $1 million. It just kept going up and up and up. You see, I should have, as you know, bought that condo for 700 grand that very first year. But at that point in time, I still kind of had that same mindset that, oh, this is way overpriced. And I didn't see the opportunity, just like what you described with that individual. When he saves up money, that house he could have bought today for $125,000, it's no longer 10 years. Now he has to save 15 years because that house that's at 125, 10 years from now is going to be 225. So you have to keep working harder and harder to acquire those assets when you take that approach, rather than going all in right away, leveraging them up, as you just described, and then letting the tenants do the work for you, rather than you doing the work to create it. And some people just don't get that. And that's why they never move beyond one or two properties.
You're right. So changing direction just a little bit.
Mm-hmm.
A lot of people that come into my world, they're interested in the education I'm giving them about syndications. Real estate
Yep.
syndications. For those that don't know, that's a group investment. You put your money in, somebody else does the work, and then they pay you, but you still get tax benefits, that sort of thing. So, two big questions that come up with, and I'll start off with the first one. And number one, they'll say, "Okay, Jeff, I'm interested in maybe investing in this syndication deal. Should I invest in my own name in the syndication, or does it matter? Or do I need to set up an LLC because there's an LLC that actually owns the syndication?" So that's the first question. So I'll let you address that before the second one.
So when I started practicing, we started building this firm, the very first entity I set up, which was the wrong way to approach it. I should have set up a living trust first, but I didn't. I just do what most people do. I mean, you're worried about your wealth and the money you're bringing in. You want to protect it in case something happens. I mean, that was a concern of mine. So I set up a Nevada limited liability company. And today it's Wyoming. I don't use Nevada anymore, but I set up this LLC. And with that limited liability company, I put all my cash, all my savings, my brokerage account, I dumped it all into there because I recognized that in my profession, attorneys get sued, right? It just happens. And what really spurred it is my wife, she rear-ended someone and that person's threatening to sue us. And I thought, you know what? This is crazy. I don't want my career to be derailed in my investing before it even gets started. So I put in this LLC to protect it from personal liabilities, things that I could be sued for, that my spouse could be sued for. So I wanted to make sure we had all these investments protected. Now, once I did that and it was set up, then I started making investments into, like you described, syndications, okay, private opportunities that would come along. I would start investing in it. I would do it through this limited liability company. I never did it in my own name. And the reason why I wouldn't do it in my own name is because if I made that investment in my own name and not through my LLC, that is something a creditor, a personal creditor, could go after if I was involved in a lawsuit. Now, I wanted to make sure that they wouldn't be able to tap in to any funds that I received, either as a distribution or a liquidation event, that those would always go into the LLC that I own. And yeah, I could still be sued, but my creditors would be stopped from getting after my assets because my LLC that I set up in a state that has what we refer to as strong charging order protections basically means that the creditor can't take your LLC from you. They can't demand you distribute assets to them. So I can keep building my wealth inside of this LLC free from creditor involvement. Whereas if I was making that investment in my own name and a creditor came after me, now they have levers they can pull to put leverage onto me. Hey, I'm going to take that private equity you have in that company. I'll take the stock from you. Oh, you have a syndication interest in a limited liability company. Great. I'm going to put a charging order on your interest. And then when you have a liquidation event or they're making distributions to you, those are all going to go to me. You'll never see them. That does not occur when you put that buffer entity in place. And so as professionals, I mean, dentists, physicians, I mean, your targets. I mean, people see dollar signs when they see MD and they take those typical dollar signs and 10x them because they assume that you have the deepest pockets of
Mm-hmm.
someone to go after. So we want to protect it. And quite frankly, if you're in business for yourself, I'm less concerned about medical malpractice than I am about the people you employ. They are your greatest threat because now the law has empowered them to sue you for such things as discrimination that may be non-existent, harassment, again, that could be non-existent. They can sue you for having to work overtime when maybe they decided to do it on their own. You didn't know about it, didn't pay them for it. Now that's a claim that can be brought against you. There is a litany of ways in which employees can hang their employers out to dry. And the thing is that because you're the one controlling that company, you can't escape personal liability for those claims. You may think, well, I have a company, I have a shield. Not for those types of claims, you don't. They look right through them, they go right after the owners. So I want to make sure I'm protecting my assets from the workplace risks that come from being a professional.
I've never thought about that because the majority of the people that are watching this or listening to this, they do have their own company or practice. So that's certainly a good advice that never even thought about. The second question revolves around what we've already discussed is depreciation. Because they'll say, hey, Jeff, I've just got into this syndication, I'm busy treating patients or working full time. I was under the impression that when the general partner does the cost segregation, they get all this accelerated depreciation. Man, I can use it to offset my W-2 income, but is that the case? And I'm like, well, it doesn't work that way. So what are your thoughts about that?
It doesn't. You're right. But you could make it work that way if you structure yourself properly. And that's why you want to be working with people who understand that. So let's assume that I had some syndications and I had some other real estate. So this is a conversation you have to have with your spouse, right? I've had talked to so many dentists and physicians, they will tell me, oh yeah, my wife, she's going to be a real estate professional. I said, oh, you think so, huh? Have you had that conversation yet? Maybe you're going to need a divorce attorney, not an asset protection attorney, if you think that's going to go down the way you're anticipating. But if both people are in alignment, right, spouses as to what they want to do, if you want to reap those rewards, what you have to do is you have to qualify for real estate professional status. One person in the marriage has to qualify. And that means they have to spend 750 hours, 50% of their time on real estate related activities. And then they have to materially participate. And so, in order to qualify to do that, you don't have to qualify on the syndication side. You just got to have one or two rentals on the personal side. And if you spend the time on those two properties for a year, and then you materially participate and you spend at least 100 hours, and that's more time than anyone else spent on your properties, any one person, then you qualify and you can reap those deductions. If you don't do that, then they're not going to be available to you. So that's the general rule. So there has to be some planning around it. The other thing is that if you're not trying to take it against your W-2 income, I tell people, well, hey, the investments you're making, if you have a rental real estate income coming in, those deductions will offset that other income. Any other passive income you have in your portfolio can be used against the depreciation that flows out of the syndication. So it's a matter of looking where your income sources are and then developing out a plan. And that's why I always tell people you need to have a strategy session. You need to be sitting down with people who are going to analyze it and help drive the right type of plan for you.
So if knowing what you know now,
Yep.
you probably know where this is going. If you
Maybe.
could do it, if you could do it all over again, maybe you're sitting down with your, if you know, teenager, 18 years old or 19 years old, maybe they're getting ready to go to college or they're in college, and you sit down with them and you say, look, knowing what I know now, this is probably what I would recommend you consider doing as far as how to maybe structure how to go about focused on passive income, maybe replacing your expenses as early as possible. I don't, whatever your beliefs are. So knowing what you know now, if you could go back to maybe college, would you do anything differently when you're starting out?
I mean, well, yeah, definitely. I would have started investing a lot sooner. Um, but what I would have done differently is understood this thing about trading your time,
Mm-hmm.
right, for money. And I would have spent more time on the investing side, less time on building the business side. I would have also aligned myself with people who know more than me and learn from them because I have found that, just in building the business and going through this, you can learn so much from a mentor. And you don't have to pay this. You can find people that are willing to help you out because what I found, I mean, just in my own practice, people come to me and they show that they have a genuine desire to learn something. You just want to give back. It's just part of what you want to do. You want to see them find the same successes that you've had. And if you can help them do it, great. There's satisfaction in that. But by finding that mentor, then it helps you then or aligning yourself with professionals that understand what you're doing. It's going to help you get past that learning curve much faster. And it's going to create a more benefit for you from what you're doing on a much larger scale. And the other thing that I realized over time is that we tend to get caught up on sometimes on the wrong things. I mean, we've been talking about taxes. And I used to be the one that wanted to eliminate my taxes, didn't want to pay any taxes, and I did it. I didn't pay taxes for 4 years legally, but I realized there was a cost doing that. It prevented me from growing my portfolio because lenders wouldn't work with me. So I didn't understand the difference between what I call good deductions and bad deductions when it came to tax reductions. Didn't understand that, hey, by doing certain things in my business, if I want to sell my business, that I want to make sure that anything I'm doing, I can take what I call below the line to increase my EBITDA. So when that private equity firm comes in, you're going to maximize the sale. I mean, I've sold business before and I left over $10 million sitting on the table because I didn't understand it at that point in time. And so there's a lot of little things like that that go into it that you're not going to learn, you're not going to know until it's already in the rearview mirror and you go, I wish I would have done that different. So getting with people who understand that, knowing, plotting that out, I think is important. And then the last thing is that I find is you always got to balance things. And that I ask myself, I used to be, hey, you can do this and it's going to do X for you. But if I do this thing and it makes X for me, what am I missing out on? Meaning, rather than going after X, maybe I should be going after Z. And a lot of people get too focused on X and they don't realize that in order to generate, to do this activity over here, it's going to take an equal amount of time as it would be to do this thing that's X times 10. And we don't look for the X times 10 because we get so focused on this X over here because we see a number and think, oh, this is great. And I've been down that road before where I realized, hey, I should have never done this because I could have got so much more return. Because as you stay with time, we're limited on time. So I want to make sure that my time is always being put into the things that are going to produce the highest return for that time. And when people tell me, oh, I can save you this, yeah, great. I've realized now you told me I could save you $10,000 a year in your taxes. First question is, how much of my time? And if it's more than 2 or 3 hours, not interested because I know what my time's worth. And what I could do with that time is I could do something else that's going to make for me $80,000 a year in savings. And so that's where I want to be with that time. And so that's what I find a lot of people, once they get it, they understand what I'm referring to.
Yeah.
And it just takes a while.
Yeah. I think you really don't understand the importance of time, and till you get older. Because almost like think about a football game. First quarter, both teams, not a big deal. But what happens in the 2 minutes left in the fourth quarter? Everybody's like always looking at the clock. Time's running out, and it's so important. And I think about life like that. I think maybe right now I'm in halftime and going into the third quarter. So now I'm really starting to look more at, okay, well, the score's tied, and I'm starting to look at my time, more. And I'm trying to stress this to my kids. And every time they bring somebody over or whatever over, it's like, look, guys, I know you're not thinking about this right now. You're 18, 19, and you're out having fun and this and that. But this right here is going to, chart your path to which way you're going to go. Are you going to be behind a desk for 30 years or be your own boss, So, and I encourage people that are parents, or you're around other, kids or whatever, because, growing up, a lot of my friends that they're really wealthy, but they're we go over the house all the time, and their dad or their parents, they would never say anything to us, never like, hey, what do you want to do or whatever, and this is what I do. I would have loved that. I would have loved that. So that's one of the things I'm doing to give back, is just to give that option, and maybe put a little seed in there. Maybe in a few years it'll grow, that when they're out and they're like, man, this sucks. Well, I remember what Jeff said. Maybe there's something to that. So I encourage people, to do that. But
When I was
really,
when my son was in high school, I went and got him a job with a friend of mine. He's a developer. And I said, you have any openings for a laborer? And he goes, well, yeah. He goes, that work sucks. I said, I know it sucks. I used to do it. And he said, well, who do you want? I said, my son. He goes, really? I said, yeah, I want you to put him in the crappiest position you got. If you got some, he's got to crawl under a house and get dirty. I want him doing all of that. And so I made my boy go out and do that work. And he came and he goes, Dad, I don't understand why I'm doing this. And I said, A, you're making money, number one. B, so that you realize what you don't want to be doing for the rest of your life. And I said, that's why you're doing this right now. And after about 3 weeks, he didn't like it at first. And he started coming home, he's filthy dirty. He said, because I get it. And he goes, he started looking at the people around him, and it just started sinking in that, hey, these people are always going to be doing that job, And he said, hey, they show up late, they try to leave early, they take long breaks, and I'm doing more of the work. I said, Carter, these are all things you're going to carry with you for the rest of your life, and it's going to create that drive for you. That's going to help propel you into finding successes and learn from what you see going on the job sites. And so he did, and it's just so now we rehabbed a house together. He gets it. And so those are the things I think are really important, as you talked about with kids.
that's cool. I have a real quick similar story. My son, I didn't pressure him to get this job. It's a pretty cush job working at the local country club in the tennis shop. He's a big tennis player, right?
Yeah.
So, every day after school, he would go there and he have to sweep the courts or do whatever, like for 3:30 to like 7 or whatever. So a couple of weeks ago, he's like, Dad, I'm thinking about giving my 2 weeks notice. Like, he's not crawling under houses or anything like
Yeah.
that. Like, oh, okay, what's going on? He's like, well, this takes up so much of my time. So, I can't go work out. I can't go do stuff with my friends. I can't do this or that. And I said, son, you just learned a big, I didn't have to tell him anything. I said, you just learned a big lesson. He said, what's that? I said, you want to be in a position where you control your time, not somebody else.
Mm-hmm.
It's like, I never thought about that. I was like, yeah. So I said, you see the importance of time. It's not, it's good money he was making, but now he, because I had a big lawn service growing up in high school and college, and I
Yeah.
think, I think that's what really made me go the route that I want to be. You know, I didn't want to work for anybody. I love setting my own time and schedule and doing that. So I think he has that a little bit in him. So that was pretty cool to see that kind of that light bulb come on. Like, yeah, I don't want to work for anybody.
Totally.
But if anybody wants to learn more about you or your company or anything like that, maybe kind of look at what they're doing and get some strategy help or whatever. What do you suggest?
Well, we're going to put a link, I'd say, in your show notes to set up a free strategy session with us. You just click on the link. You can go there, you schedule your time to meet with us, and then we'll sit down. We'll spend 30, 45 minutes and just, spitball out some ideas and lay out a proposed plan of attack going forwards on, what you should be doing when you're going to go out and start investing. Maybe you currently have investments, how those could possibly be restructured. Talk about estate planning. A lot of people haven't thought about that, or they know they need it, but they just haven't committed to putting a plan in place. And so there's many things that we could focus on. And at the end of the strategy session, you'll leave that better than when you came into it because of the advice you're going to receive.
Awesome.
Absolutely.
Well, I appreciate you allowing the listeners to have that. And guys, if you don't know about Clint and his Anderson Business Advisors, make sure you follow him. We'll put a link to that below this too. But I appreciate the time you had today. This is great, and hopefully we can do it again sometime.
Absolutely. Thanks for having me.